Well, I think the biggest transition that occurred in 2024 is that the Fed moved from being on hold with tight monetary policy to reducing interest rates to help the economy and the labor market. That shift is a dramatic shift. Inflation has come down to a very reasonable level, near 2%, which is the Fed's objective. But now coming to the fore is concerns about the labor market. So it's no longer just concern about inflation being too high. Now inflation's lower. The Fed's recognizing that the unemployment rate has risen a little bit, and it doesn't want that genie to get completely out of the bottle, and is taking interest rates down to keep the economy stable. Our base case is that the Fed needs to continue on its path of cutting rates, likely beyond that 3% neutral level. If we think about what will perform well in a bond portfolio in that environment, very likely high-quality fixed income, investment-grade securities are going to perform well. That would particularly be areas like mortgage-backed securities, which are starting off at attractive yield levels. Investment-grade corporate bonds could do well, but we are seeing that they're starting at a more expensive credit spread or risk premium level. There are scenarios that could challenge either side of that. One scenario would be that inflation starts to reemerge. In that scenario, we could see the Fed pause their cutting cycle and stabilize interest rates at a higher level. Another scenario that's possible is a more significant shock to demand. In that situation, we could see the Fed cut more rapidly, like in a traditional rate cutting cycle. If that were to happen, we would see tremendous benefit in fixed income prices, at least on the high quality side, but also more dispersion with credit market weakness. As we think about investing in the bond market in 2025, I think the name of the game is dispersion. As we talk to our global research team, we think there are tremendous dispersion in outcomes that we could experience in 2025, both from corporate profitability and revenue growth to the level of defaults that we see and the ability of companies to access capital markets. I think success in 2025 will be defined by making sure portfolios are positioned to participate in lower rates as the Fed delivers them, and also protect from potential downside should we see more economic volatility. I think the most important thing is that we don't need an incredible change in the macroeconomy for bonds to work for investors in 2025. You would get a tailwind should the Fed take interest rates lower, but it's not required. And for investors at this point, they can earn attractive yields and diversify their portfolios.